Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question for Bill, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. So without any additional delay, here's the host of today's program, Bill Bullington.
And we're back. Finally. Hey. God, I'm going to start off the show by reminding everybody that we have a workshop coming up, and it's how to generate income from your retirement, or for retirement from your portfolio. Or you don't necessarily have to be 65 or older for this, by the way. If you want to know how much money you need to be able to have to walk away from your job without taking a pay cut, that might be an interesting topic for you to take a look at, because the numbers are exactly the same. And if you are already retired and you're concerned about being able to generate income from your portfolio, feel free to attend that workshop. Just go to my website, bullingtoncapital.com. You can sign up there right on the seminar page. There is no cost to attend, but seating is limited. And I think we have about 80 seats left. It's at the Corporate College, 4400 Richmond Road, Warrensville Heights. It's right over there by the new Eaton building, which is very nice. Just recently into that for the first time. And I think it's going to be interesting. There's a couple of changes that have been made in the financial services industry. One of them is impacting a lot of people. If you have IRAs, 401k plans, Department of Labor got involved because they're the ones that actually oversee that retirement plans through the ERISA Act. And they decided that they came out with some rules, and they're going to make the rest of you guys behave like I've always had to behave since I launched my firm. In other words, you have to operate in your client's best interest. Really? It's taking you that long to come around to forcing people to operate in their client's best interest? Yeah. By the way, if it's not an IRA, you're still fair game. They don't have to be fair. No, just kidding. There's this lot of differences in that kind of stuff. Anyway, it's created a little bit of paperwork for everybody in the industry. But I think it actually helped my business. There are models, generally accepted models. And a lot of them are put out by research that's owned now by Morningstar. Morningstar bought Ibbotson, which was a consulting research firm that worked with asset allocation, how you're supposed to diversify your investments to minimize risk, that kind of thing. So they've got some generally accepted materials there that are past government standards, and it actually requires us to overweight slightly. When I say require, it's not like they're going to come out to my office and force me to put everybody's accounts in there. But if I'm not doing that on my own, when we get audited, big trouble. So the bottom line is you'd better be doing these things. And the models, generally accepted models, have you overweighting large cap domestic stocks, large companies that are headquartered or domiciled in the United States. They have you putting a larger proportion of the money in that than other types of categories, which falls right in line with my high dividend model. So it's the first time that I can remember in my career where a government regulation actually may have helped my business. That's an amazing thing. Might have actually helped my business, because those are really good strategies. I like that we're going to be talking about that in detail. And another thing we'll be talking about, there's some changes in how the stock market is broken up into various sectors. They're going to add another sector now. They're going to take real estate separate from financial services, which they had been lumping them together. And now they're going to separate that and make it its own particular sector. separate from financial services, which I think is a pretty good idea. And another move that I think is probably going to help out the high dividend models. And I'll go more into that at that workshop. So make sure you sign up for that. It's bullingtoncapital.com. There's no cost. And we've got 80 seats left. That's August 13th, by the way. That's a Saturday morning. Going to start at 8:30. They put out a really nice continental breakfast there. They do some great smoothies, and they use a local company, Vitamix blenders. Wonder how much Vitamix paid for that. I'd be interested to find out. But I love Vitamixes, by the way. I can't tell you how many of those I've actually given away to people. And if you want to save some money, they have a store over in Solon where they return machines and then they refurbish them, and you get a big discount. So anyway, come there. There are going to be smoothies, a continental breakfast, and we're going to look at several different ways of generating income through dividend-paying stocks and some other sources of income-generating investments, because that's a big deal. And actually, it's amazing to me when you look back over the history of the stock market, how focusing on stocks that pay dividends tends to do extremely well. A lot of the strategies are relatively simple and can keep you in the top, say, 25% or so of professional money managers without having to go to Harvard. How cool is that? Anyway, we're going to be talking about it at the workshop, and feel free to call in with any questions you might have today regarding that kind of stuff or any other financial matters related to saving, investing. Those are the things that we've really focused on at Bullington Capital. It's how do you make your money last? That's the investing portion of the equation. The saving, we've got some things that are going up on a website shortly that you'll be able to download a spreadsheet that you can do a budgeting in, because that's what saving really is. It's like, where are you spending the money now? I'm working on a story that for the radio, one of my clients, I think it was a great idea that he had, and it's worked out extremely well for him. And we're going to get together because I need to actually get his permission and before I share his story with the rest of you. And we're going to talk about how we're going to do that. Because, it worked out really, really well for this guy. And it's so common sense. Anyway, so a lot of stuff coming up. And feel free to email me, incidentally, if you have topics that you would like me to try to cover on this program. Feel free to email and bring them up. I'll do the best I can to address those things. I think it's a great thing that we can communicate like this. By the way, if you'd like to hear the radio program, you can download it as a podcast on iTunes. You can go to my website. It's there too. And now we're going to add it to YouTube. So you'll actually have the radio show on YouTube. If you miss a show, you can go to YouTube and pick it up, and it'll be there. You go to iTunes, the podcast, Bullington Capital Report, it's there. How cool is modern technology? And it just blows my mind that we can do all this kind of stuff. And most of it's relatively low cost. That's the thing that really freaks me out. I'm used to paying an arm and a leg for everything. And cost has just come down so much. In everything. There's an inflation rate, and the inflation rate really depends on your age, incidentally, because the vast majority of inflation has come from the medical field. A tremendous amount of inflation, I shouldn't say the vast majority, but a tremendous amount of inflation has come from the rising costs of health care. And see, as you get older, as an economy or as your population ages the way ours is, things start wearing out. Your body parts start wearing out. I can tell you, I hurt my knee about 8 weeks ago. Now, when I was in college, I would have been maybe slowed down 2 weeks or so. 8 weeks later, and I'm still not back. So that's what happens when you get older. I don't know. I'm preaching to the choir, anybody that's above the age of 50 out there. But for you young people, this is what happens. You start going to the doctor more frequently, and the doctor's bills have gone up 3 times faster than the overall inflation rate. 3 times faster. So inflation rate really depends on your age. When you're relatively young, your inflation rate could be negative. Because you can buy a laptop computer that's got bells and whistles on it for under $500 today. And 20 years ago, those computers didn't even exist. And the ones that you did get that were the high-end computers were $2,500 to $3,500. I know because I bought them. That was 20 years ago. And today, for $500, you can get a computer that will smoke that computer. So it really, your inflation rate really depends in large part on how old you are. Cars. Watch what happens to cars. Tesla, the new electric car has got the small one for the general population, $35,000 new, $7,500 tax credit. So it's $27,500. $27,500. And guess what? You can charge that at home every night. Your electric bill is going to go up about $15 to $20 a month. That's it. So how much are you spending on gas? And how much more efficient would it be to get an electric car, which, by the way, is really cool anyway, and is faster, has super acceleration. That's what I'm talking about. Things are, as bad as a lot of things are, things have never been this good. And life is a lot easier than I was thinking about that yesterday. I have a client in the office. We're talking about it. As soon as he left, it actually spawned a lot of thoughts coming through my mind. I was thinking back to when I was in high school, and I'm telling you, my life is significantly improved in every way. Our air conditioning stunk. The house we lived in didn't have very good insulation, so in the winter we were freezing. Yeah, it was amazing. We had to spend a lot more money on heating and air conditioning because we didn't have the technology, all the wrap they put on the houses before they put the siding on, the insulation that goes in the middle, the triple pane or double pane windows. It's just technology has made everybody's lives a lot better. And a lot of the costs from a lot of that stuff are down relative to incomes. In other words, you're not spending as high a percentage of your income on some of these things as you did 20, 30 years ago. So that's kind of a cool thing. And things are getting better. They really are. Don't watch the news. The news is depressing. The news puts bad news up front. Why? Because it sells ads. So, and I guess under that circumstance, you can watch the news because if you know that you're going to be inundated with bad news, then you become a little bit more immune to it, I guess. At least I have. I was going through the Wall Street Journal this morning, and I skip a lot of this stuff. Yeah, there was a shooter in Texas. Okay. You know, what's really surprising by that, by the way, is that didn't come up on Bloomberg's news screens as a leading story until later in the day, and everybody else had been covering it, right from the get-go. And I got to tell you, 330 million people across this one country. I'm surprised. I'm actually surprised that kind of stuff doesn't happen more frequently. I really am. That's an awful lot of people to be freely for it to be legal for them to carry guns. So anyway, I don't want to get into a lot of those discussions, but things are pretty good, and things are looking better. In fact, the Brexit, how spooky was that? Stock market drops. Do you realize the market now has recovered 100% of the decline from the Brexit? It's recovered. Every dime that was dropped, that was lost, has been recovered. And so for people that panicked and sold or cut back, and by the way, this happens in my industry frequently. Something comes up, it scares people. They watch too much news, it gets too negative, they get too depressed, and then they pull the trigger, generally at a really bad time. You've got to be on guard against that kind of thing. Got to be on guard against it. That's one of the reasons I do this show. It's one of the reasons investing is an occupation. Because if it were easy, everybody would do it, and we'd all be rich. And it just doesn't work like that. It's just not easy. It's not incredibly difficult. You just have to figure out what you need to put up with. Again, we're going to be talking about that Saturday, August 13th. That's 8:30 a.m. Corporate College East. Go to bullingtoncapital.com to sign up for that. So I'm here to tell you, investing is 95% psychological. 95% psychological. 5% is knowing what to do. 5% is knowing what to do. 95% is actually having the guts to do it. 95% of your success is going to come because you knew what you knew what to do, or you got with somebody that knew what to do and did it. And it's probably not going to work out like you think it's supposed to work out. Most people think you figure out where something's going to go ahead of time, you buy it, and then it goes there. Like stocks. This is going to go up. How do you know? Well, because I read all this and this and this, and here's the story. They got a new drug. It's going to cure cancer. This company's got a new service. Everybody's going to want to subscribe to it. And that's how they think it works. And that's really not how it works. And very rarely, I should say, does it work out that way. Very rarely does it work out that way. How it works is significantly different than that. And it's not as complicated as you might think. So I'll give you an example. The dividend model. What am I doing? I'm looking at the biggest companies in the world, breaking them down into 10 major sectors, soon to be 11. 10 major sectors that make up the stock market. And I take the 4 out of each of those sectors that have the highest dividend yield currently. And I'm going to invest equally in them. Equally in them. That's a big deal. That's a big difference. Your S&P 500 is a market cap weighted index. I probably won't have enough time to explain that in detail before the commercial break, so I'll wait until after the commercial break to do that. It's coming up here in another minute or so. But equally weighting over market cap weighting. I want you to remember that. When you're out there, if you're looking at investing and managing your own money, remember what I said. Equal weighting over market cap weighting. Market cap weighting is something you do if you are a multi-billion-dollar institution. And those guys promote that tremendously because it's in their best interests. Anytime you hear somebody talking about how market cap weighted index outperforms 80% of actively managed funds, well, that's not true, first of all. It is a high number, but it's not 80%. And it does outperform a lot of professionals, but that doesn't mean it's the best way to invest. In fact, when we come back, I'll explain how that works and why you might want to consider equal weighting over market cap weighting, but only if you want to make more money. Anyway, I hear the music. That means the commercial break is about to come up. You're listening to Bill Bullington right here on 1420 The Answer. Stay tuned because I will be back after these messages. And we're back. Hey, you're listening to Bill Bullington. I'm here every Saturday morning from 11 to noon on 1420 The Answer. This is the Bullington Capital Report. You can go to my website to find out more about us if you'd like to. Bullington Capital Management. Actually, it's bullingtoncapital.com. Sorry about that. But we were talking about equally weighting versus market cap weighting. The S&P 500, which a lot of people refer to as the stock market. It's actually an index made up of 500 of the largest companies in the world that are mostly headquartered in the United States, but do trade on the U.S. stock exchanges. So it's an index. It's kind of a barometer, a benchmark. And it does pretty well. It outperforms about half of all mutual funds over a long time period. Over short time periods, it can outperform a tremendous number of them. If you go back to 2009, it's actually outperformed about 80% of them during that time period. Does that mean that you should chuck everything and just invest in that index? Well, I guess if you don't mind being down 50% twice in one 10-year time period and still showing a negative return, then yeah, go ahead and do that. Okay? I'm not real happy with that. I would not be happy being down 50% twice over a 10-year time period and 12 years later still have a negative return. I'm just not satisfied with that. Call me crazy, but that's not satisfactory to me. So I don't care how well it does in the short run. What I really want to know is, what are my risks involved in investing that way, and what are the returns? one of the simplest ways to improve on returns is to equally weight your portfolio. There is an equal weighted S&P 500 exchange traded fund that you can invest in. And it's only been around since 2003, so you don't have the other numbers, but it does have a tendency to recover a little bit quicker. Why? Well, because the companies that are number 500, like 450 through 500, they're a lot smaller than the big companies. But they're going to be treated equally. Instead of giving them less money because they're smaller. By the way, the smaller companies are the ones that are growing faster. And this is the part of the logic behind the market cap weighted index that I'm just not fond of. When a company is smaller, when Microsoft finally broke into the S&P 500, they were only putting a little bit of money into it. They were putting more money into Exxon and Walmart, who didn't have anywhere near the growth rate that Microsoft did. Inevitably, that's going to cost you money in the long run. And that's my only drawback. And by the way, if somebody said, look, you have two choices. You can either invest in short-term CDs or the S&P 500. I'm going to say, oh, no problem, S&P 500. It's not that I don't, it's not that I hate it. It's just that it's not my preferred method of investing. The dividend models that I'm talking about have a tremendous number of benefits. Stocks that pay dividends tend to be fairly successful. They tend to be relatively old, so they're not going to have that really fast growth rate. I've got another model to capture those things. But what I'm trying to do with the dividend model is getting a very large, very well-established company that's paying a dividend. When the share price goes down, the dividend yield goes up. That's your cue to know to buy it. If you're already holding it, you are going to reinvest those dividends if the share price continues to drop, which they do in many cases. A lot of times the share prices will be dropping for a year or longer. One of the reasons that model has done so well this year is that last year it was loading up on energy stocks. So not only were the dividends from those stocks reinvesting and buying more shares at higher yields with lower prices, but we rebalanced that on a quarterly basis so that we took some of the money from the stocks that had been doing well and moved it over into those stocks while they were down. Now that they've recovered somewhat this year, that propelled the portfolio significantly higher. And it's beating the S&P 500 by a mile. Okay, but that's how it goes. Now, occasionally the S&P is going to outperform that. There's no doubt. S&P will outperform almost all strategies at least 40% of the time, which confuses people. Because they think that, well, if you're going to beat it, you've got to beat it all the time. Really? You ever watch a basketball game? Did you watch much of the Cleveland Cavaliers? No. They were down 3-1. They were behind. No team in the history of the NBA has ever come back from that deficit except us. You know why we did it? Because we're from Cleveland. We're used to having things hard. But they didn't know that. But that's what investing is. Very similar to that. It's like a very competitive event. You're not always going to be ahead. But if your strategy's good and you stick to it, eventually good things happen. And that's how that works. And the economy is never going to go down and stay down and not come back. That's not going to happen. That is not going to happen. I can tell you that will not happen. Yeah, and if we have a war that's strong enough to wipe out, the entire planet, well, then your money's not going to have to, you're not going to have to worry about the money anyway. You see what I'm saying? And aside from something like that happening, markets aren't going to go down and stay down. These guys, the gloom and doom guys, there are a lot of people on the planet that just aren't happy unless they're miserable. And I've met personalities like that. I know people like that. They're not bad people. They just have a strange disposition. They just don't seem to be happy unless they believe that the end is coming. I just can't agree with that. I think things have never been quite as good as they are. And I know they haven't been. Yeah, do we have problems? Yes, we have problems. We're always going to have problems because we're always going to have people. But this is part of the whole part of the equation of what makes a successful investor. It's mental. It's your outlook. What do you think? I think the bigger risk that we all face is that with low interest rates, it is incredibly difficult to keep up with higher inflation rates. And I think higher inflation's coming. I do. I don't think it's coming tomorrow. Actually, I don't even know. Don't know when it's going to come. But I do know that sooner or later, inflation kicks in. By the way, if you'd like to call today, ask a question, have a comment, 216-901-0945, 216-901-0945. And I got to go to Pete, and you've got a question regarding mutual fund expenses?
Yes, Bill, this is just a general question regarding expenses and really any type of mutual fund.
Sure.
How come I have a portfolio, say I have a portfolio of $1 million
Right.
versus someone who has a portfolio of $500,000?
Right.
Why am I paying more for that mutual fund company to manage my money, given the fact that I really don't spend any additional time or effort?
How are you paying more?
Portfolio. As a percentage, they charge a percentage of your net asset.
You're in a mutual fund that charges you more for the more money you have?
No. I'm saying if person A has $1 million portfolio and person B has a $500,000 portfolio, the first person is paying double in terms of expenses.
Well,
for that mutual fund.
That's because he has twice the money.
Right, but as far as the actual time and effort required on the part of the fund manager to manage that larger portfolio, there's really no difference in terms of their actual cost of managing one versus the other.
And you're talking about mutual funds, correct?
Mutual funds, or really any type of investments, even if you had like a private money manager.
Well, let me ask you a question. Would you do extra work and not expect to get paid for it?
No. I mean,
well, because I have to tell you, where you're making a mistake here. There is extra effort for more money. In fact, one of the biggest detriments to a mutual fund is they don't stop taking money in, and the more money that you're managing, the harder you have to work to find places to put that money. That's something that you.
That. I mean,
okay. Well, listen. You understand that. So now, is it harder to manage twice the amount of money, or is it easier to manage twice the amount of money, based on what we just talked about?
It depends. If you're in an index fund, I say the cost is the same.
Well, if you're not in an index fund, and that's another mistake people make, and let me save you some time. These are the things you need to know. The mutual fund expenses is number 3 on the item. That's number 3, expense ratio. First thing you want to know is the peak to trough decline in that fund from the last major correction. Go back to November 2007, go to March of 2009. Find out how much it went down by, because I don't care what the expenses are. If that fund went down too far, you're not in it anyway because you puked at the lows, you sold, and cost yourself a tremendous amount of money. So if you don't know what that number is, you don't belong in the fund.
No, I think you're missing my point.
No, I got your point. But what I'm telling you is you're focusing on mutual fund expenses. That only counts, it only matters if you're looking at 2 identical investment strategies. If the strategies are identical and you're going to get the same thing from fund A versus fund B, then the expenses matter. They really matter. But if they're doing something different and that different has produced a thing called alpha, that's what a lot of mutual fund people like to talk about, basically added value, either had higher returns with the same risk or had lower returns with a lot less risk. Okay, that's alpha. Then it's a moot point because you're getting benefit from the fund by investing that even after the extra expenses.
Sure, I understand all that. The analogy I would use is you show up to a car wash, you're driving a Mercedes, I'm driving a Kia. Should the Mercedes pay more to go through that car wash?
And they don't. They don't. So if you and I both invest in SPY, we pay the same thing. And if there's another fund out there that's got a lower expense ratio, then we change over to that one because we're getting the identical product. You hear what I'm saying? We're getting the identical product. So you have to take identical products, and then that experience, the mutual fund expenses will matter. If it's not an identical product, then what you really need to know is you need to know more about the fund. What are they doing? why would they charge a higher amount? Because you know that. Are you familiar with the Boston Red Sox? Do you know who they are?
I'm sorry?
Do you know who the Boston Red Sox are? Well,
Sure.
They're owned by a guy that used to be a hedge fund manager. His fund had the best performance. It was better than any mutual fund that ever existed. He charged 4% of the assets and 40% of the profits. Would that have been worth it? Worked for
in retrospect, sure.
Yeah, that's what I'm talking about. So it goes beyond expenses. Are they important? Yes. Are they the most important? No. It's not the most important thing.
Right. I understand all that, but just the example that I use, say you're in an S&P.
Well, yeah, if you're going to invest in an S&P fund, then yes, you need to try to find the least expensive one because there's nothing adding any other value there.
But why don't they charge a fixed fee regardless of the size
They do.
of your investment?
It's a percentage. Oh, why don't they charge a fixed dollar amount?
Yes, fixed dollar amount. You have $1 million, I have 500,000. You know, there's no extra work involved.
Well, you'd have to.
Why am I paying double?
You'd have to call and ask John Bogle that. I don't know. I don't know.
Do you understand where I'm coming from, though?
Yeah, and you.
On that?
Yeah, and you can go out and accumulate those stocks on your own and put together your own portfolios, and run those models yourself. You still won't be able to do it as inexpensively as some of the options that are available institutionally. But
right.
that's the whole thing. Expenses should be number 3, by the way. The first thing should be, what's your peak to trough decline? How much risk am I taking? Because it doesn't matter how cheap the fund is. Cheap can be really expensive in the long run, and most times it is. So you really want to know
I'm more than willing to pay for performance.
Well, it's not just the rate of return either, because that one of the reasons so few people invested in John Henry's fund with the big returns was because it was incredibly volatile. So not only were you paying an awful lot of money, management fees, you also put up with a wild ride. But in the end, it made more money. And I'm just telling you right now, 9 out of 10 people will say, "Oh yeah, I can take the risk. I can take the risk." And then when you get hit with a big drop, half the people flee. They leave the fund. That's just the nature of the business.
Right.
But so that's the first thing you should be looking at, and you got to be logical. You have to be reasonable with yourself. You have to be honest with yourself. How much of a decline am I willing to put up with in an effort to reach my goals? And only you can answer that, by the way. There is no right answer for everybody.
Right.
So
okay.
you
all right, Bill, thanks very much.
Well, hey, thanks for calling. Appreciate it. Yeah, how much time before the next? Okay, got about 2 minutes here. I'll try to get to Doug and Parma. Doug, we got about 2 minutes before commercial break, but you can hang on. We can finish after if we don't finish up. And are you there?
Hi, Bill. How you doing?
Hey, good.
Good. Listen to you for a couple of years. I enjoy your program thoroughly every Saturday. I really look forward to it. I used to play ball for Ohio State, and I can remember your old football days. So there
thanks.
You go. Goes way back when.
Well, that's
but
awesome.
Anyway, get to my point. Forbes Special Situation Survey. I've been involved with them for about 2-3 years. Okay. They recommend maybe about 20 different stocks. They do write-ups on them. They do recommendations for maybe on a quarterly basis. Done fairly well with them. I mean, they're doing a pretty good job. There's about 20 different different stocks. I mean, everything from Apple all the way down to some small stuff. Green Dot Corporation and Obotech and whatnot. But anyway, just wondered. I've thought about going to your seminars. I thought about sitting down and talking to you. I wonder, as opposed to a Forbes type special situation survey. You ever heard of them? You ever,
Oh yeah. I look at that stuff pretty frequently, actually. And the special situations tend to work out really well. In fact, there's another guy that listens a lot, and he has an account with us. He was talking about R.R. Donnelley, which falls into the special situation category. This one, it came up just on Friday on one of my momentum screens, and it has a classic breakout pattern that all it means is that it looks like institutions are accumulating the stock. And because R.R. Donnelley is splitting up into several smaller companies, that's those special situations you're talking about, the split up. The spin-offs, that tends to work out pretty well over time. So I like Forbes.
Yeah, some of them have done quite well, and others have just been, stinkers. But whatever. I guess when you're dealing with maybe 20 or 20 or 25, sometimes they and surprisingly they've recommended getting out of some, and I turn around and I follow them after, and they've done quite well.
Yeah, absolutely. Hey, Doug, can you hang on a second? We got to take a real quick commercial. You're listening to Bill Bullington right here on 1420 The Answer. We'll be back after these messages. And we're back. Doug, you still there?
Yeah, I'm still here, Bill.
Yeah. Hey, I like that the Forbes Special Situation Survey. I read a lot of stuff all over the place, and I'll tell you, every once in a while you do come out with some pretty good ones.
Good.
Yeah, I'm writing a little booklet. It's actually an update on the a book, Look Out for the Bull, that I wrote.
Oh yeah, I've heard about your book. I can't say I've never read it, but I heard about it. Yeah, talked about it on the radio.
Yeah, it's super basic because actually most investing is pretty basic. You have to get your head around a lot of definitions when you first begin, and it's not so that you know what they're talking about. It's so that you know what not to pay attention to.
Right. Well, the biggest thing I see is, and I've been investing now for 15, 20 years or so.
Right.
Is the biggest thing is when those market drops come in. You just got to have the guts to stay in there, and it's tough sometimes. I mean, when you look at a 400, 500 point drop, you say, gee, why didn't I get out? Or this Praxis thing, you talk about that, and it just came back just like that.
Yep.
I mean, you gotta have the guts to stay in there, and that takes a lot of fortitude, I'll tell you.
It does, and you really have to have a lot of confidence in what you're doing. And,
exactly.
It's actually why I have a job, because you got to have the time to do it too.
Yeah, I understand.
Not just so it works out pretty good though. I mean, if you use some really basic stuff, wait till and I can't wait until they break up the S&P into another. They're going to add one more sector. They're breaking up the financial services into real estate and the. I think it's going to help the performance of the dividend models.
Yeah, that's great. That's great. So you got a seminar coming up. Maybe I'll sign up for it and come down there and see what you have to talk about.
Well, that sounds good.
I love listening to you on the radio.
Well, thanks. Make sure you remind me that you're Doug from Parma.
Okay. Okay, will do.
Okay.
Take care and have a good weekend.
Thanks.
I enjoy your program.
Thank you. You too.
Okay.
Yeah, they're actually, what another good publication is? I like Forbes a lot. I like Fortune a lot. I like Barron's. Out of all the publications I've read, they do have a tendency to be somewhat negative from time to time. And a lot of times there's really just not that much significant that's going on, and they have to fill the pages anyway. So, but I would say, all in all, I've gotten more good investment ideas out of Barron's than I have just about anything else. In fact, I don't know if you remember a couple of years ago, we were talking about Corning. Well, I found that in Barron's, and I bought a long-term leap on Corning. And man, that turned $3,500 into over $50,000. And I found that in Barron's. I mean, that was Barron. Everybody could read it. We talked about it. I was in that trade for almost 2 years. That position, anyway, was almost 2 years, and I talked about it multiple times. And you had anybody that was following that had a tremendous number of opportunities to get into that stock. And that, like I said, it came from Barron's. And it came from Barron's and having the understanding of how to put a value on a stock that really doesn't take that long to do when you know what to look for. And I'm telling you right now, the two most important features when it comes to what makes an attractive stock are sales and profit margins. Those are it. If the company doesn't have sales, don't look at it. Wait, and that is not an investment. That's a bet. That's a speculation. Okay, it's not an investment. So if you don't mind betting, then go ahead and do that. By the way, the leap I bought, that was a bet too. That's why I didn't put a lot of money into it. Because if I'd have put a lot of money into it, it could have gone the other way. In fact, about a week after I made my investment, it was down 50%. Think about that for a second. A week. You know why? Because it knew Bill Bullington was going to buy it. That's why. So it went down 50%, and then it came back. And that's one of the better returns on any investment I've made in my career. You go from $3,500 to $55,000. That's pretty good. That doesn't happen often. I can tell you that too. But I wouldn't have gotten it if I hadn't known how to identify it. And, again, we're going to go over a lot of this stuff at the workshop. The more conservative things, by the way, are the dividend-paying stocks. Those are the more conservative things. And they're not, they're still stocks. They fluctuate a lot. In fact, we're going with big companies that have been around, had an enormous amount of success. We're buying them when they're down. That's when their dividend yields go higher. Dividend yield goes opposite the share price movement. If I have a $50 stock and it has a $2.50 dividend, okay, that's 5%, right? The stock goes to $25, they don't cut the dividend because the share price dropped. That has nothing to do with the dividend. The dividend stays at $2.50. Now the dividend is 10%. Think about that for a second. That's all I'm doing. That's really all I'm doing. And I'm spreading it out, and I'm diversifying amongst the 10 biggest sectors that make up the market, and I'm putting 4 stocks from each one of those sectors in there. So I only have 2.5% of that portfolio in a particular stock. What I'm doing is I'm trying to make it hard for me to get wiped out. I'm making it hard for me to get wiped out. That's a key. You want to learn how to prosper in the stock market? First, you got to learn how to survive. And that's part of the survival process. When you think about from what we're doing there, I've only got 10% of that particular portfolio in one sector. And in that sector, I've got 4 different positions. That's a really nice level of diversification. I don't think you really need to go much farther than that. I really don't. So we're going to be talking about that in detail at the workshop, because you can use a model like that. One of the reasons I picked that, incidentally, and the guy from Pete, he calls in every few weeks asking about the fees. I have to tell you, fees are important, but they're not the most important thing. Dividend models tend to bounce back faster than the models that don't pay dividends, and it's just not just my model. Look it up, do some Google it, and do some research. They bounce back faster, and if you give them enough time, their long-term returns are generally better than the ones that don't focus on dividends, like the S&P 500. It doesn't focus on dividends. Okay, so if you don't want to be down 10 years with a negative return, that's what you get when you want to buy the S&P 500. That's going to happen to you. I'm not a big fan of that. I'm sorry. I don't care how cheap it is. It's not worth it. To be negative for 10 years is, I would die if that was happening in my portfolio. I don't think anybody has the mental tenacity to to hang in with that. Bad idea as far as I'm concerned. And like I said, if it were my last choice, if it were my last investment choice, I would still make it. I would still take it because you're in stocks. And in the long run, yeah, stocks will get overpriced. That's actually what happened. The first time the S&P 500 breached 2,000, it was overpriced. It didn't belong there. Okay? And it was overpriced in large part because of the way they buy the stocks. It didn't have anything to do with the fundamental value of the companies. It was the structure of the fund. It was the fund's strategy that caused it to buy overpriced stocks and then push them higher. So that's what I meant about understanding your strategies. You've got to understand the strategy. Market cap weighting is you're buying stuff that's going up because it's going up, and you're buying it after the fact. Now, after Apple's gone way up, you add to it. After Apple drops again, now you're selling it. So you're buying at highs, selling at lows. The reason that tends to work over time is because your larger companies will tend to acquire other companies and fuel their growth. And yes, over a long, long time period, that can make that it's very profitable. But you have extremely long stretches where that makes no money because they buy stocks that are overpriced and then they add to them. And then they wait until they crash until they start to sell. So it's got good points. It's got some points that I feel like are not so good. It's got some disadvantages. And I think you can do a lot better doing some other things. And by the way, doing a lot better doesn't necessarily mean making more money. I would much rather have a return that's 20 or 30% lower if my risk is 40 or 50% less. And think about that for a second. So that's something that is not talked about. They don't teach it. The new questionnaires that they're coming out to try to help investors, it's not helping. They don't understand. I have an idea, something I use. I call it decline tolerance. There are some other firms now that are out there that have huge money behind them that are promoting programs that focus on the declines as a method of determining what the right portfolio mix is for you. And I think that's phenomenal. I'm like, hey, have they been listening to my show and copying my stuff? No, I'm just kidding. But I think it's great now that that's picking up traction. The same way when I first started my business, one of the reasons I left was because I wanted to use exchange-traded funds. Now, you've got to remember, they were relatively new back then. The brokerage firms considered them more aggressive, something that they couldn't put into their business models, and they wouldn't allow me to. I had to leave because I wanted to use them. And now, guess what? It has been the fastest growing category for investment assets in the entire industry for years. And I'm just telling you, this is one of the future developments that's going on right now. The questionnaires are going to get simpler. More simple they are, the more effective they have a tendency to be. Not always, because nothing's always true, but all other things being equal, if you know approximately how much you could be down by, I think you're much more comfortable when that eventually happens because you thought about it ahead of time and you prepared yourself for it. And again, that number is going to be different for just about everybody. I just got the nod. I only got about 40 seconds here. Hey, go to my website. Email me if you have questions. It's bill@bullingtoncapital.com if you can't find the website, but it's bullingtoncapital.com. You can sign up for the workshop. Feel free to email with questions you might have personally. If you'd like to come in or like to meet, talk about your situation, that's fine. We can do that. We're still accepting new clients. So, and other than that, I guess I'll have to wait till next week. There were an awful lot of stocks that came up on my scans, the momentum scans. I'm not just a dividend investor, by the way. That's one of my investing personalities. Another one is I like buying stocks that are going up right now. Yeah, that's another strategy. We'll have to talk about that at a future seminar. But anyway, now I got the nod. I got about 10 seconds left here. So I appreciate everybody listening. Appreciate the kind comments from the listeners there. Have a good week, everybody. Good luck and good investing.
You just caught another episode of the Bullington Capital Report, broadcasting every Saturday morning at 11 a.m. on AM 1420 The Answer. If you have a question and would like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or contact him through his website, bullingtoncapital.com. That's bullingtoncapital.com.
Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and/or investment strategies recommended and/or purchased by advisor, or product made reference to directly or indirectly will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional.
The preceding program has been paid for by Bullington Capital Management, LLC.